So I think you see the basic concept. The margin account allows you to borrow. If you buy quality things and then diversify, and then we're going to leverage it and we're going to tier it. Because this, listen, it's a business. It's not investing. And I don't know that I'd even call it trading. Now, man, I got blood all over me. I fell down earlier outside. So we got a portfolio, right? And, you know, you look at it like a pie. And we want most of the pie right here just to be good old-fashioned closed-end funds, CEFs. All right. Now, we know when we put money in, we get 1 to 4 to day trade, right? And we can invest, or not invest, put to work up to 1 to 3, right, to create income. Now, that would be running kind of hot, so we probably want to do more like 1 to 2. So if I got 100 in, say 100K, I'm going to try to borrow 100K, right? And so I'm going to earn on 2K, and I'm going to pay interest, right? So you're going to have a loan payment, just like you would if I bought a house and I put 20% down. I'm making payments or have a mortgage on the other side. I'm leveraged 5 to 1, okay? And that's the money game that you're playing there. So that's the money game. So in margin, what blows people out is they're trading stocks, penny stocks, growth stocks, doing things. What we want to do is get paid. So we already talked about, number one, you got anchor stocks, right? And most of these are CEFs, REITs, right? BDCs, business development companies, okay? Number two is leveraged indexes. And the way we're doing it right now, it could change. So leveraged indexes, we want to be, so we got this being, probably 50%, and this is probably 30% or 25%. And then the 20 will be the more risky. And for being more risky, we want returns of like 60 to 120. Over here, we're looking for, 25 to say 50. And over here, we're looking for 12 to maybe 20, right? And that's annual yield, okay? That will pay us in the form of income. Now, my hand is hurting. Pay us in the form of income. And now, so tier 1 are anchors. Tier 2 are leveraged indexes. These are funds like this. These are by, damn, I'm drawing a blank. IWMY and the WDTE. And these are the NASDAQ, the S&P, S&P, and this is the small caps. And these pay weekly. So every Friday they're paying, okay? And then yield max, which is going to be this 20%. So these are index based. So these are based on an index. So closed-end fund, index. So we got most of the money fairly safe because CLM, CLM and CRF and these kind of funds, these are closed-end funds. They have their own inherent risk. All investing involves a risk. All trading, all putting your money into the stock market of any kind involves risk. Putting your money in a bank annuity involves risk, okay? Driving to work involves risk. So all of this money is at risk. But what I'm trying to do is make income. And the way I'm going to do it is I'm going to leverage my money. And I'm going to try to protect myself the best I can. And I don't know, hey, maybe it doesn't work. I don't know. I'm just showing you what I do. I put most of it in these. 30% in these, and now in these is where we're going to get juice. Go look at Misty. We're up 100%, and the dividend yield is 120, okay? So this thing's making up for other stocks. Tesla has been on the move, right? making up for other stocks. We got Coney. This is on the move, doubling, paying 100% yield, okay? So we can use our trading skills right here. We can use diversification. We can use margin, which gives us leverage. And then we don't do anything stupid in there. The job is to grow the balance, which is our money, right? Our money. What is it? What's our available withdrawal, right? Available withdrawal. And then what? Income. How much are we making? How much are we making? What's our balance? And I want to double it. You don't do it in one day. You do it as deals come on. Right now, Chinese stocks are coming down. And so in our letter, Second Income, we track about 100 of these, between closed-end funds, REITs, BDCs, yield max, and why am I drawing a blank on these other? This is what happens when you start getting old. Defiance, my goodness, I apologize. So, so we got closed-end funds, CEFs, right? And then down here, you're going to have REITs, right? And you're going to have what? BDCs. And so as things come on sale, you might pick them up, right? And then you're going to have index-based option income funds. That's what the ones we're just talking about. And then we're going to have yield max, which is single stock. And that's yield max. But the term yield max is because they're maxing it. So we got to make those positions smaller because we got single stock risk. Because the game, we're not trading. The game is we're trying to make income. Now, these are going to have price erosion, and we'll do another video on how to avoid price erosion. But one way to do that is if you can swing trade. When you catch stage ones on these, you can buy funds for most of those that are 2x. So you pick up TSLL, and if it goes up, it offsets a lot of erosion that you experienced in TSLY, and you get some of your money back. And because you're only paying interest, couple swing trades, and it doesn't matter if your interest was 8%, 10%, 12%, you're going to pay it back with a trade or two. And if you're a day trader, like I was green every day last week, knock on wood, I only made $1,600, but $1,600 buys what? Times 3 of CLM. What if I do that week after week? I don't know if I can, but then we also said what? I'm making 2,300 dividends. So if you add that up, that's $3,900 in positive equity in there. Okay? And the portfolio is generating $92,000 in dividends. How long? But you're going to see it'll go up and down. So we'll do another video on that.